Hey, this is Sasha. Thanks for joining me for another episode here on Hungry for Returns, where I answer your trading and investing questions in more detail. Now, I like video because it's much more in-depth than what I can do on email. So if you have a trading and investing question that you'd like to submit, be sure to submit one on our website at tradersfly.com. You can submit a voice, a video question, even an email question if you want, and at least then, if it's a good question, we can go ahead and record an episode for you so that way your question gets answered in detail. So let's take a look at this week's question.
Hey, Sasha. My name is Ryan Cochran. I've been swing trading for about a month now. I've seen 10% returns so far, but I'm having some difficulty of figuring out when I should sell a stock that's not moving, particularly ticker symbol NG. I've held it for 3 days, and I've not seen gains or losses whatsoever. Would you consider that a stagnant market, and should I just go ahead and sell and get in at a later time, or should I continue to hold? Thanks. Bye.
So what I want you to get from this video is I want to share with you two main points. There's more points beyond that, but two main points from this lesson. The first is that stocks don't move when we want them to, and the second point is trading and looking at penny stocks is more like eating junk food. Okay, so first thing is, when we look at Ryan's question, and I didn't have a chance to answer it in time before that sluggish move because it was about a week ago that he asked the question, which this NG ticker symbol, which is a penny stock in my book, anything under $10 is a cheaper stock, so it's typically considered a penny stock. So over here is where this stock was acting sluggish and moving around, and this is what he was asking right around this time frame. Now, you can see what happened to this stock is it sold off in a big way. And what typically happens is we're always anticipating a move in a stock right after we get in it because we're watching it, we're active in it, we're focused in it, right? We want something to happen. We're looking for action. And unfortunately, the market is much slower than our perception of time, and that's why you have to be much more patient. That's why investing takes multiple years. So if we're looking for day trading activities or multiple days holds, you're really looking for breakout movements and for a movement where it's breaking, let's say, resistance or support, and that way you can actually get in on the movement of the stock. Now, if you're getting into a stock where it's just kind of digesting and moving sideways like this into a triangle pattern, well, it's digesting, and it could be digesting for weeks, months, or even years. So, you know, depending on how long you plan to hold this, if you're a swing trader, you might look at, hey, I might hold it for 5 days and then get out if it's sluggish. If you're a day trader, you might hold it for 1 or 2 hours if it's not moving and then get out. If you're a long-term investor, you might hold it for 4 to 6 months. If it's still acting sluggish, then you might get out of it. Remember, when stocks are acting sluggish, okay, that usually means they're building for something. They're building either to the upside or to the downside. Okay. In this case, when we talk about penny stocks, which is my point number 2 that I want you to get from this video, is penny stocks are typically like junk food. Most of the time, when you look at normal stocks, they're going to appreciate with time. Okay. So you look at any normal long-term company, Apple, look at Netflix, any big company, they're looking to appreciate with time. Penny stocks, on the other hand, in general, depreciate with time. Now, some of them, yes, they can break out, and you can see some really amazing returns. Like you look at NG here, boom, broke out in 2003, you know, got into the $20 level, but then eventually, you know, it tumbles back down. Then again, you might get that massive run up, but again, you know, that's the natural tendency of penny stocks. So you think about a junk food, when you're eating a hamburger, you know, from a fast food restaurant, it might taste good initially, and that's where you might get that little spike for a year, a couple months, depending on how long that penny stock can sustain those things. But then eventually it comes back down because you don't feel as good. It's not as good for your body as maybe eating a salad, right? So that's the thing, is that when these stocks build, typically for most penny stocks, you can make money both sides, right? You can make money on the short side or the long side. But in general, the natural tendency is for them to sell off, and you can see here, this is what happened. Unfortunately, you know, the question was asked about a week ago, so I can't be that quick to answer these video questions just by the time we get the video going. But I hope this makes sense in the future, is that if you're looking for a stock to break out right away when you get it, you got to be a little more patient, right? You have to wait a little bit longer. So if you're a day trader, you might wait 1 to 2 hours. If you're a swing trader and your typical hold time is 30 to 60 days, you might hold it for a few days. If you're a long-term investor, you might hold it for 3 to 6 months, and if it's still sluggish, then you might get out of it. So normally that's what I would look at. And if you're trading penny stocks, you want to be a little more careful, because remember that it's a little more like junk food, where yes, you get those initial spikes, but overall the natural tendency is for them to sell off. Now that's not always the case. You know, there's some penny stocks that do well, continue to rise and continue to appreciate and become bigger companies, but the majority of them don't typically work out, because if you look at even the newest companies like Spotify that came out, right, new companies that come out, you know, they still open up at the IPO around 160. You look at, you know, even things like Twitter that were a bit cheaper, you know, right around between the $40 and $60 range. So when you look at penny stocks, you need to be a little bit more careful about that. So anyways, thank you so much for joining me in this video. If you have a question, by all means, submit it on our website, and I can be sure to answer it here on our show. So go ahead, click this button. You can submit a question or get on the newsletter list so you get updated on our new videos, or just subscribe on YouTube, and that way you get notified as we release new videos. Thanks for joining me, and I'll see you next time.